People ask me this question all the time. They come up to me and they say, Bryce, look at this deal I just found. By the time I pay off my mortgage, I pay all of my expenses, I'm gonna make $100 a month. Is this a good deal? So while you may think that that's enough information to tell whether or not something is a good deal, in my opinion, it's not enough information. You can't look only at the monthly cash flow to determine if something is a good deal or not. And just keep in mind that before I go through all of this video, that the information I'm about to give is only applicable to rental properties and not house flips. House flips is an entirely different game. This video, we're specifically talking about rental properties with a monthly residual income. Okay, so back to the question. If somebody comes to me and they say, Bryce, I'm looking at buying this property, it makes $100 a month, is it a good deal or not? Now, the first thing that I'll ask them is how much money, how much cash are you bringing into the deal? Now, if they say, I have to bring $100,000 cash to buy this house and you're only gonna make $100 back a month, that's an awful deal. I would never do that in a million years. Now, if you make $100 a month, but you only have to bring $1,000 to the table, then that's an amazing deal, and I would do that all day long. So it's kind of a balance. You have to look at multiple metrics to decide whether or not a property is a good deal. So I do look at cash on cash return, but I also look at that monthly cash flow net per month. So again, it's not as simple as just saying, this is how much money I'm gonna make. You kind of have to balance things and look at the overall picture. Now, that extra metric that I'm gonna talk about today is something called cash on cash return. If you guys are new to the channel, thank you so much for being here. Let me introduce myself. My name is Bryce. I talk about everything here, personal finance and real estate on YouTube. If you enjoy videos like this, please be sure to give me a thumbs up, and also be sure to subscribe down below because that really helps us out. And also, if you want, you can see more into my personal life, you can click down below and follow me on Instagram. So first and foremost, I'm going to explain what cash on cash return is. And it's really not that difficult, but if math is really scary for you, I've got a spreadsheet down in the description section below. You can click on that link and it's a deal analyzer. You can punch in all your numbers, and then on the side, it'll spit out a whole bunch of numbers like net operating income, cash on cash return, cash flow per door, and it'll do everything for you so that you don't have to. So again, if this is scary for you, check that out. It's a little bit easier, but I promise you that the math really is not that difficult. Plain and simple, cash on cash return is just a percentage, and it's the percentage of how much money you're gonna get back, how much you're gonna receive every single month or every year or whatever it is, compared to the amount of money that you initially put in to buy this deal. Let's say that I'm going to buy a, just theoretical property for $100,000. Now, we're not gonna pay cash, because if you use cash, your cash on cash return is gonna be significantly lower, and we want that number to be higher, which is why I always recommend using leverage. So with this $100,000 property, let's say we need to bring $20,000 to the table as a down payment. Over the course of the next year, as you own this property, after all your expenses, everything is paid, you're gonna receive $7,000 over the course of 12 months in net income. Now, you'll take that $7,000 and you're going to divide it by the amount of money you brought to the table. This includes down payment, closing costs, repairs, anything that you needed to do to get this property, and you'll divide it by that amount. So if you receive $7,000 net income, you divide it by $20,000. And again, in our super simple theoretical example, that would come out to a 35% cash on cash return. Just remember that you're dividing your net profit by the amount of money you bring to the table and not by the purchase price of the property. For simple, easy numbers, the metric that I always try to achieve is I have to get a minimum, an absolute minimum of 20% cash on cash return. And in most cases, I beat that by quite a bit, and I'm usually in that 30 to 40 range for cash on cash. Okay, now that's awesome. Now we know what cash on cash return is, but that's not the only metric that we need to look at. So you initially came to me and said, this deal makes $100 a month, and my cash on cash is also 20% or higher. So should I do this deal? If you come to me, I'm still gonna say no, even though those metrics are pretty good. And here's the reason why. Regardless of the percentage that I'm going to make, I still have to charge what I call a nuisance fee. I have to be able to make enough money that it's worth it to me. Regardless of what anybody says, rental properties are real work. You have to deal with tenants, you have to call electricians and plumbers, you have to deal with taxes at the end of the year. I mean, it's not just this juicy passive income that everyone thinks it is. Yeah, that's an aspect of it, but it's still a job. So if you were to come to me and say, Bryce, my cash on cash return is over 20%, but I'm going to make $100 a month on this deal, should I do it? I'm going to say no, because $100 per month is still not worth it to me. Even though the metrics check out, it's not worth it to me to manage tenants, deal with plumbers, deal with electricians, deal with maintenance and repairs and taxes and all the stuff that comes with a rental property. It's just, in my mind, not worth the effort. I'm not going to do all of that work for an entire month for $100. I mean, most likely that's going to come out to what, like $8 an hour? I don't know what it comes out to, but I could go to McDonald's and make more money than that. So having said all of that, I look at two main metrics when I'm looking to purchase a rental property and know if it's a good deal. The one we already talked about is cash on cash return, and number two is net cash flow per door per month. For any deal to be worth it to me, I have to make, like I said, a minimum of 20% cash on cash return, but I also have to make $300 net per month per door. So if I'm buying a fourplex, I need to net $1,200. If I'm buying a triplex, I need to net $900. Duplex would be $600, a single family home would be $300. If both of those numbers are in check, then I'll buy it. As long as I can hit both of those numbers, then it's worth it to me, because that $300 per door is enough money to cover my nuisance fee. It makes it worth it so that if anything comes up, that it's worth dealing with all of the hassle to make that much money. And not to mention too, if you've got some crazy big maintenance expense that pops out of nowhere and you're only making $100 a month, that could literally wipe you out for the next 2 to 3 years, if not longer. As an example, this year I had to replace a furnace in one of our rental properties. Now, I've only owned that place for about 18 months or so. That furnace cost $3,600 to replace. And even though I set money aside every single month to be able to cover maintenance and repairs and expenses, you know, we've had little things that have come up between now and then, and so that fund has kind of gone down. Then it'll go up, but then it'll go down. So over the last 18 months that I've owned that property, with all the little expenses, I didn't have enough money in that fund to cover a $3,600 furnace repair. It wasn't a big deal. I had the money elsewhere. It came from a different fund, and that's okay. That's not the point. But the point is, if you're making only $100 a month, and let's say your maintenance funds have been depleted, I mean, that will literally wipe you out for 3 years. Why would you own a property for 3 years and do all of that work for free for 3 years? That just doesn't make sense. And two, that's assuming that nothing else comes up or happens over that next 3 years, which statistically speaking is very unlikely. On the other hand, luckily for me, this property nets that $300 per month or higher. And I think we're actually closer to $400 per door on this property. And that's awesome, because that means that if we did have a huge repair like this one and we didn't have enough reserves to cover it, we would be net zero after 8 or 9 months. So I realize that's kind of a long-winded response to basically say, figure out what your cash on cash return is, but also figure out what your net number is per door per month to kind of cover your headache fee. Tenants are annoying, things break, and no matter what, this is going to take some of your time. It may not be a ton of your time, but it's still some of your time. No matter who says that this business is passive, don't believe them. They're lying to you. This is real work, and you absolutely have to be compensated for your time. And I know that I already briefly touched on this, but I just want to say it again. When you're calculating your cash on cash return, you also have to make sure that you include any repairs, closing costs, or renovations. If you're looking at a prospective property, you run all the numbers and you're like, great, I'm at 20% cash on cash return. This is awesome. But then you don't take into account, oh, well, I had to spend $5,000 to fix up the place a little bit before I could get a tenant in there. Now you're not at $20,000, you're now at $25,000. And so I haven't run the numbers on that, but your cash on cash could now be closer to 12% or maybe 8%. So while it seemed like it was a good deal in the beginning, you didn't take into account every single dollar that you had to put into this property to get it ready to rent. and it doesn't become such a good deal anymore. So definitely take those things into account before you buy a property. The next video I want you to check out is this one right here. It talks about how I physically run the numbers on any property that I'm looking at buying. So in this video, I pick a random city and I find a random property and I run the numbers on it live right there in front of you. So you can see exactly how I do my breakdown, how I calculate my maintenance, expenses, repairs, all that kind of stuff. And if you're just getting started, that might be a good one for you to check out. Thanks so much for watching, guys. Appreciate you being here. Let me know if you have any questions down below. Happy to answer them for you. Otherwise, I'll catch you next week.